Kitco Mining special coverage of the Deutsche Goldmesse is brought to you by Faraday Copper.
Is the Fed going to pivot after the good inflation number in November? Ronald-Peter Stoferle is Managing Director, Incrementum AG. Ronnie, great to have you back on Kitco.
Good to see you, Michael.
It is a good time we have you here because we had that good inflation number where expectations were, how would you say, they came in under what they were expecting. After that, we saw the spring in gold prices. We also saw a rally in equities. Are we seeing a pivot?
I'm not sure if it was a good inflation number because we're still at ridiculously high levels of inflation, obviously. But I think it's pretty much clear now that we have seen the peak in inflation numbers in the United States for this inflation wave. Yeah. So I expect that this inflationary wave is now trending lower. This is because of the base effect. This is because of the lagging effects of the shelter component, for example. This is also obviously because of the recession that is coming to town pretty soon. And therefore, I expect more inflation surprises on the downside over the next couple of months, which of course, takes off lots of pressure from the Federal Reserve. They will say, well, we did it. We crushed inflation. And of course, then there will be less pressure on the Federal Reserve. However, I think that from my point of view, this pivot will definitely be different than the 2018 pivot. In 2018, let's not forget, inflation numbers were way below 2%. So obviously it was easier to make a real U-turn. So this pivot will be more of a process from my point of view, but it will affect the gold market. It will obviously affect everything that is inflation sensitive. And as we are seeing already for break-even rates, they already trend lower since basically spring. And therefore, I think, as I've said, inflation will come in much lower over the next couple of months.
I want to talk a bit more about what you saw on those inflation numbers there and kind of what they mean. Could you expand on that, what the various components that you saw that? But what was really interesting is what you said about downside risk. What is that?
Well, actually, I think that first of all, those are year-on-year comparisons, and we know a year from now, if we would have to see inflation numbers coming in higher, we would have to see significant moves on the commodity side, especially on the energy side. I think one of the main reasons why inflation numbers held up a little bit lower than expected was basically the housing market and especially the shelter component. Now, we are now also seeing there that those numbers are coming down. We are seeing significant stress in the real estate market. Obviously, mortgage rates are up more than 120% in the last 18 months. So therefore, I think let's put it that way, this negative wealth effect that the Federal Reserve wants to orchestrate to get demand down and to get inflation down. It's working out. However, I just don't see a soft landing happening. I think that's it's not going to happen. Somebody said the last soft landing that he saw, they made a movie about it and it was called Sully. So I think that we are now slowly moving from an environment where everybody was just staring at inflation numbers, and we're coming into an environment where people will focus much more on the recessionary pressure that we're seeing. And we're already seeing it. The Michigan Consumer Sentiment Index has made new all-time highs. We're seeing the ISM basically confirming that we're heading into a recession. We see the 10 leading indicators that I follow very closely. They forecasted 5 out of the last 5 recessions, also now below zero. Therefore, I think recession is now basically our base case, and I just don't see. The Federal Reserve, it has to choose between the lesser evil. Will it be inflation, but inflation coming down already, or on the other hand, to deal with the recession and rising unemployment? And I think from what I see, they will choose higher inflation instead of the recessionary pressure that will be coming up. And I think, in my keynote before, I made some comparisons and basically laid out why Jay Powell is not Paul Volcker 2.0. And I think that Paul Volcker, for example, he had the full support from the White House, first Jimmy Carter and then Ronald Reagan. And I suspect that Jay Powell will have the full support of the White House in case the US moves into a recession. I just don't see that the Federal Reserve will be blamed. And therefore, I think, I'm not sure if when is it, 14th or 15th of December, the next FOMC meeting, but this might be the last hike in this rate hike campaign.
Let's talk about that soft landing. There has been news reports that are supportive of the financial press has been finding key points that are supportive of a possible soft landing. Mostly having to talk about the job sector in the U.S. You've had you certainly had the tech layoffs. But it looks like there's, how would you say, it seems to be a matter rather of like they're flushing through the excess right now, whereas it's like the broader job market continues to be strong. But then there's seeing pieces not only from the CPI numbers, but also looking out that there really has been a drop off in prices in terms of either going through energy, going through shipping, commodity costs as well, pointing to what's the counter to a soft landing, Ronnie?
Well, I think, media or Wall Street, they always forecast only soft landings or Goldilocks scenarios, yeah. And a friend of mine, he's a sales trader, he says bears don't get paid on Wall Street, yeah. So this is probably the reason why they are always more on the optimistic side, yeah, than on the realistic side.
I think to be fair, was like you says, there's within the realm of possibilities.
No, of course it is. I cannot rule it out. But I mean, let's face it, Michael. We have seen on a nominal basis the biggest wealth destruction in the history of mankind. Yeah, 60 trillion being wiped out of financial markets, in the bond market, in equity markets, commodities. Real estate is not even included in that calculation. Then crypto markets, 60 trillion. That's 65% of global GDP. It's pretty significant. Yeah. So of course it affects our spending behavior. But I think that, and that was the leitmotif of my keynote. It was koyaanisqatsi, which means life out of balance. And we're seeing so many pockets of the market being out of balance. Currency market, the bond market posting its weakest, the world bond market, most negative performance since the year 1865. For a balanced portfolio, the weakest year since 1928. We're seeing that everything is out of balance, of course, also when it comes to energy markets. And we're seeing, obviously, that this rate hike campaign is probably one of the most aggressive and fastest one in the history. So at the beginning of the year, we're at 0% interest rates. Now we're heading into the direction of 5% in the first quarter 2023. So given the fact that we've got the highest debt ever, not only on the side of the governments, but also corporates and private individuals. Therefore, I think it's fair to say that we've got the highest sensitivity to rising interest rates. And if you combine that with very quickly rising interest rates, this just causes trouble. And we're seeing now, as Buffett famously says, when the tide goes out, you see who's swimming naked. And we're seeing, stuff like FTX coming, blowing up. Yeah, we're seeing so many scandals and bankruptcies now really appearing. I think this is a clear sign of this enormous contraction of the broader money supply that we're seeing. Now, I think it's really important to say that actually a recession, first of all, is something pretty normal within a cycle. And we haven't seen a real recession in 2020 because basically governments were taking control of everything and they subsidized everything. However, I think that perhaps more on the, let's say, on a philosophical note, we kind of financial markets guys, we think that all the the rate hikes are discounted immediately. And perhaps financial markets are able to discount everything immediately. But actually, in the economy, private households, business owners, they're not able to discount everything immediately. So I think we're now seeing slowly that consumers are waking up, saying, well, Jesus, inflation numbers are high, but my mortgage rate for my house is also up significantly. They're experiencing that, they have to adopt their spending behaviors. And we're seeing it all over. Just have a look at the latest earnings. And then we're seeing also for business owners, they now slowly realize that they have to accustom to this new setup, to this new paradigm. And they make changes. And therefore, I think it's important to say that the labor market is always lagging to the cycle. Yeah, so there's a time lag between 1% to 2% from the first moment of a rising inflation environment. So therefore, I think we have seen the top in the labor market. I think we will definitely see a rising unemployment. Definitely. We're already, as you pointed out, we're seeing it on a technology side. And therefore, as I've said, a recession is our base case, but perhaps there's going to be a positive surprise.
Paint us a picture what you're seeing in 2023. What is the Fed doing, or what has the Fed done, and what is the state of? Let's constrain it. And let's say what you're seeing in the U.S. market. What's the most likely outcome at that point?
Well, obviously the US dollar is one of the major driver for markets at the moment. Yeah, if you got the dollar right in 2022, it basically saved your portfolio performance. Is the dollar already rolling over? I mean, we've seen a pretty nasty downturn over the last couple of weeks. I'm not 100% sure actually. I think this bull market still has legs. Because if I compare the situation in the United States to the situation in Europe, I've got a hard time making a strong long-term case for the euro. Also have a hard time making a really positive case for the British pound or the Japanese yen. Of course, there might be short-term rallies, short squeezes, whatever. But I think this strength of the US dollar will continue to be an important driver for financial markets. Then I think that we are moving into full-blown earnings recession in the United States. I would say that the fiscal stimulus, and this is probably one of the main takeaways from the 2020 COVID crisis. I think that fiscal stimulus will in the future be more and more important, and I think probably we should focus more on fiscal policy and less on central bank policy. Yeah. So this is probably gonna be expect more fiscal stimulus than monetary stimulus. Yeah, I think that's one of our key topics. And of course, fiscal stimulus has got a much faster and more direct impact on the economy and of course also on inflation numbers. And then I would say, what were the two big trends in asset management over the last couple of years? First of all, ESG. We're seeing now that 2022 was basically the year when we all, we in this industry, we kind of knew, but I think most people realized that actually we need commodities, we need that stuff, yeah, as a basis for our industries, yeah. Commodities aren't something bad. It is something that where you have to try to get a really safe supplies and therefore I think there's some sort of a mind shift happening when it comes to commodities. And I talked to a friend of mine who said that the German government is actually very, very interested in directly sourcing supply for all sorts of critical elements and commodities, and they're doing offtake agreements and so on. So there's definitely a shift happening. So ESG has been one trend, and I think that ESG will be kind of there will be reconsiderations, like we've seen it, for example, for uranium with the European Union taxonomy. And the second big trend in asset management was passive investment. People said, well, I don't need an active asset manager anymore. I can just buy the ETF. I think that going forward, and I'm probably talking my book because we're very active managers, but I think for the period ahead, you have to be very active. Trade the rallies, and then you can go out of the market or start shorting in. I expect some sort of a volatile sideways trend going forward. I think it would be naive to think like it would continue like it did in 2020, that it's the Fed reverses and there's fiscal stimulus and everything just rises in a straight line again. And I think that inflation, as I've said at the beginning, will probably be pretty sticky. So I would say that 3 to 4% will rather be the new floor for inflation rates. So I expect another inflation wave, mainly driven by labor shortages, of course, especially when it comes to skilled labor. So this wage price spiral is just starting to spin. But there are other structural drivers for inflation that we wrote about in our previous In Gold We Trust report. So to sum it up, I think ESG will be kind of rediscovered. Active management will be important. And as you know, I'm from Austria, and Austrians are keen skiers. And I say, well, if the weather is fine and you've got fresh powder and the sun is shining, everybody's a good skier. But when it's icy, when it's foggy, when you're in steep terrain, you can really tell if somebody's a good skier or not. And it's going to be the same thing with asset management. It's not going to be as easy like in the previous bull market to make decent returns, but you just differentiate. Good skier, bad skier, good asset manager, bad asset manager. That's what I'm foreseeing. And I hope that we're in the good skiing or good asset management camp.
Good luck with skiing, Ronald.
Thank you.
My name is Michael McRae with Kitco Mining. We're covering Deutsche Goldmesse here in Frankfurt.
Kitco Mining special coverage of the Deutsche Goldmesse is brought to you by Faraday Copper.